Hello, this is Brett Rentmeester, president of WindRock Wealth Management. WindRock is a unique wealth management firm combining a top-down macroeconomic perspective with an entrepreneurial mindset to seize on investment opportunities. I'm pleased to be joined today by Bud Conrad, chief economist at Casey Research, to discuss his view that the U.S. is entering a recession likely by 2016. Bud is the author of Profiting from the World's Economic Crisis, and he's got a bachelor's in engineering from Yale as well as an MBA from Harvard. Bud, thanks for joining us today.
I'm really looking forward to our interview, Brett.
Great. But as a backdrop for our discussion, the U.S. is now 7 years into a bull market in equities, but at a critical juncture. With expensive valuations and more visible cracks in the global economy, the risks ahead seem heightened. And what was simply a story of crashing oil prices earlier in the year has morphed into an all-out rout in commodities. And this, of course, has coincided with increasing weakness in China, which has impacted the emerging economies. Yet through all of this, mainstream economists don't see a spillover risk into the U.S. So my opening question, Bud, is can the U.S. avoid trouble while the rest of the world appears mirrored in this increasing turmoil?
Excellent overview, Brett. Let me say that the answer to that question is that the U.S. is going to follow the rest of the world into a serious slowing, in my view. You can't have China, the second biggest economy in the world, stock market drop 30% in the last 3 months, have serious printing problems and peripheral country problems in Europe. We call them the pigs, Portugal, Italy, Ireland, Greece, and Spain. You can't have Japan printing money to get wealthy. And if you add in a few problems in Russia and in Brazil, you've got a world that is no longer booming like it has been over the last 6 years. And the U.S. can't be left out of that. Let me add a little bigger picture point of view here. I live in sunny California. It is gorgeous today, blue, clear skies, and it's hard to imagine problems with real estate booming, houses being bid above asking price, being bid $1 million over the asking price of $3 million. I mean, it's absolutely Boomsville here. But I see serious cracks, and I feel more like the old prophets of doom of Old Testament days saying, repent ye, because we've lost a lot of focus. Internationally, we're bringing international entanglements to the wars of Afghanistan, Iraq, Libya, Syria. It's a mess. You've seen the refugees flowing across Europe. That's our fault. Yet our news doesn't seem to notice or care. I think we're in a decline of Western Empire. We were the only kid in town after the Soviet Union imploded. Now we think we can run the place, but we don't know what's going on in China. I was there for the fall in a city of Tianjin, an unknown town by most Americans of only 10 million people. That's bigger than the whole San Francisco, Oakland, San Jose, and small towns in between that comprise the Bay Area. My point is, we think we can run this place, but we can't as the whole world together moves into what I think is a significant economic slowing.
Great. And I know you've put together a variety of slides for us, Bud, to tell that story. So why don't you go ahead and we'll look at some of the evidence you have that's getting you concerned.
I'm sort of a nerd, Brett. I love data. I love slides. I often give a talk with 100 slides in it. So today we've put together, I think it's 6 of them. I start with one, if you've got it there, and maybe you can show the rest of the people listening to us, of the slowing world trade and the slowing pricing of commodities and other things that are traded. Guess what the source of that is? It's slowing Western demand of goods, slowing Chinese exports, and slowing Chinese and other Asian country manufacturing demand for the basic commodities. That demand is seen in many prices, coal, steel, declining dramatically. In the commodity world, you say, well, how did that happen? It happened with economic slowing, and this chart on trade gives that start. Here's my story. I'm skipping a part here. My story is that we're heading toward a major recession in the U.S. One of the inputs to that is I see the current stock market rollover as a source of concern for economic growth. And I have a lot more to say about why the stock market is likely to be declining. There are no growth in earnings of the companies of the S&P 500. In fact, sales are declining in small amounts. These are quarter-to-quarter comparisons. The inventory to sales ratio is up, meaning we're building inventories rather than shipping final sales. Consumer confidence is starting to decline. In investment, capital is not growing the way you would think a booming economy should. I don't show any of those as charts, but I say, look, we've already had a rollover in stocks. That's a very current and timely indicator. We can check that every day and all day long. What does that mean for the overall economy? We usually measure that as GDP. It takes a while for the government to add it up. It's not a useful indicator of what things will be in the future, but it's a useful indicator of result. And my second chart shows a comparison of the rate of change of those two overlaid. Importantly, if you look right in the middle of the chart around 2008, you see that the decline in stocks preceded the decline in the GDP by a significant amount right around the crash that we had. And we just had a big drop in stocks. I say we're going to have a drop in GDP because of that. I'm actually quite a bit more negative than the reality of so far, how far we've come in stocks because of some other weaknesses. And so let's look a little farther down the line here at what has buoyed or kept the stock market so strong over the last few years. It is that the management of the companies have used their own cash flow and borrowing, which is so cheap, to go and buy their stocks back. The blue bars in the next chart overlay surprisingly closely with a red line of the S&P stock index. The blue bars are how much stocks are being bought back. That's a tremendous tailwind. The motive for the management is that when stocks rise, their bonuses rise, and that's their big income, since incomes to top management are limited to $1 million a year of cost deductible to the company. So their incomes come through stock rises. It's beneficial to the stockholders because they get capital gains and pay a lower tax than they would on ordinary income such as dividends. The problem is it's hollowed out the investment of the companies with that cash being spent buying back their shares rather than building new factories and plants. And where did all those factories go? They went to Asia. So we're circling around to China here. What happens is that we no longer have a middle class managing manufacturing. We've outsourced that overall. I also can point out that as we had the big stock decline into 2009, we had the big drop off in that tailwind of stock buybacks, and I expect that to start happening. In fact, the little bars on the right indicate it might be starting, but I think once it gets going, the feedback loop of stocks falling hurts the economy, and hurting the economy makes stocks fall more in a way that I think that this fall could be a serious problem.
And Bud, when we were talking before the interview, I think you had something to the effect of 45% of S&P 500 earnings were being used to buy back. Is that an accurate number or something in that range?
That's right. And 41% of them go to dividends, leaving how much over for investment in new plant productivity, new jobs, and so forth. So you've got a problem in the U.S. economy that we are no longer the big producer for the world. We used to be the only exporter after World War II. Now we're the biggest importer and biggest world debt to the rest of the world from buying things and sending our dollars abroad. Back to the sort of other half of the equation from looking at the business side, the next chart shows the employment in a red line that it declined dramatically around the credit crisis compared to the number of people that are in the population. It's a ratio. And that's never really recovered. You'll hear wonderful stories from our government that wants to make it feel good that we only have 5.1% unemployment. Well, that's the number of people that are unemployed of the measured workforce, and the workforce includes people that are looking for jobs, but not those that just gave up. For example, the reality is you have to have workers to make the wealth, and the workers as a share to the population means that all their wealth that is created has to be spread among the whole population. And my claim here is that the recovery has been far less than the stock rise by this gap between the GDP growth and the amount of people available to spend the money and grow that GDP. So my point is, I think we're more vulnerable than most people realize to a big turn down in that GDP, and that's why I'm predicting a recession next year that I think will be fairly large.
Okay. Let's go ahead on to the next chart then and just continue the discussion.
I think it's nice to understand the forces that have created the liquidity and the bubble in the stock market by overlaying the size of the balance sheet of the Federal Reserve, that's the blue line, with the rise in stocks since the big crash of 2009. It's amazingly similar in size, direction, and change. When the Fed stopped doing QEs for small periods in the middle, the stock market went nowhere. And most recently, the Fed stopped doing QE, and guess what? We just had a nice big drop in stocks. It was predictable. My own prediction for this year had been that stocks would be up in the first half of the year and that they would be down in the second half. Well, they weren't up as much as I thought they might be in the first half, but they've been down rather dramatically in the second half, and it's no surprise to me just from this simple indicator, although I've mentioned a number of other things, namely that sales are off, earnings are off, inventories are out of line, and I think that the stock market is vulnerable for even more tumbling, especially since there aren't buyers ready to buy up all the stuff that would be produced since the employment has not improved that much. So I'm suggesting things look together like they'll be fairly negative.
And I guess continuing on that, Bud, we're interviewing this, we're recording this the day before the Fed meeting begins in September of 2015. And of course, everybody's focused on whether the Fed increases the short-term rates by 0.25% or not. And you're certainly welcome to give an opinion, but what I'm more interested in is the path that the Fed takes from here. So they're clearly backed into a corner on a longer term basis with their ability to do things short of printing money. If you're correct about a recession later this year, sometime next year, how would you expect the Fed to respond?
I'm already predicting it. There is no path for the Fed except the easy one, which is more of the same. Excuse me. Look, they could raise the rates a quarter of a point. It would meet their requirement to follow through and not look stupid by telling everybody they're going to do it and then not do it. But a quarter of a percent isn't much on any scale that you would measure. You just say it's a blip. It has effect, though, psychologically. The fear that the Fed might significantly raise rates in multiple steps over a longer period of time. But the general commentary, I think, is right that the most they would do would be a one and done, one-time quarter point. Because look at what's happened. In the last month, it's been revealed that China has been dumping its treasuries. Here's what happens. You have to understand how wonderful this was up until the last housing boom. We went out and bought foreign goods with our paper dollars. The foreigners took those dollars, put them in their central bank, printed up their own currency, and then took those dollars and went out and bought treasuries with them, which meant that they bailed out the U.S. government. At one point, foreigners were buying all of the newly issued treasuries. It was wonderful. It was a wonderful time for a bubble. In fact, our housing bubble was financed by foreigners. That was nice. But in the last month, China sold off somewhere between $100 and $200 billion of holdings of treasuries, and they've got something like 1.2 trillion of them to sell. So they've got a lot of them. They may be already encumbering them on some of their investments in the Silk Road and trading in other places. Some of this is hidden through operatives in Belgium, but who knows how much they might want to dump at some point. And the question is, who will buy them?
So, Bud,
who will buy our treasury? Wait a minute. It's the Fed. They don't have a choice. If the Fed doesn't buy them, rates spike, and the federal government can't afford to pay the interest on its $26 trillion of debt. Notice most people quote numbers like $18, $19 trillion of debt, but they leave out Fannie and Freddie, which are now owned by the government, and any number of obligations calculations, which for things like Social Security and Medicare amount to somewhere around 75 to, if you use Kotlikov's measure, $200 trillion of obligations that can't be met without huge amounts of borrowing. And guess who's going to be the lender of last resort to the government? The Fed. So to your first question, what's the Fed going to do? They're going to be back printing. And then the question is, go ahead.
Yeah, and then the question is, so far, printing has revived at least equity markets, if not the economy. Do you expect that to continue, or do you sense that we're nearing a juncture where faith in central banks is waning and we may wake up one day and printing money is met with people being scared out of equities and out of the system? Do you think we're nearing that juncture?
You can see that each new tranche of new QE has had declining effects on the improvements of the economy from the previous ones. From what looked like a rollover disaster to approach the kind of thing that happened in 1929 to a sizable recovery to now a kind of flat combination of economy and stock market, but generally the same size and somewhat growing tranches. I expect that to be the case again for another round, perhaps. But at some point, as you point out, people wake up to the fact that holding paper dollars is not a safe operation because they're printing more of them. Each dollar, therefore, decreases in its purchasing power. And in that sense, you want compensation for the risk of holding dollars, which means rising interest rates, no matter how much they print. That's what's happened, let's say, 80 times over the last 100 years as currencies inflated themselves out of existence. We often point to Germany's Weimar Republic and the more recent Zimbabwe, but think of all the banana republics. Watch Brazil's interest rates, now 15%. Watch some of the African countries, or look at the previous communist states when they went through transition breaking out of the Soviet Union. Most repudiated their existing currency, came out with a promise of a new currency after they wiped out debtors and kept the game going. That's what I expect to happen in the U.S. before I die.
Yeah.
Now, I've got a bunch of gray hair, so I'm suggesting it's fairly soon that the confidence in the dollar itself declines to the level where we actually have to repudiate the situation we're in and produce a new system that promises more confidence in less profligate government spending.
On the topic of the recession, Bud, how deep of a decline do you see? Do you see an economic downturn and stock market correction that would potentially be as big as or greater than what we experienced in '08, or something that's more of the run of the mill variety, something less than that?
I don't think this is run of the mill variety. The problem we had that ran up to the housing decline, which I crashed after 2009, up to 2008, 2009. I predicted that. I could see the liar loans, the subprime lending that was to people who couldn't pay back their loans, and that this bubble was going to burst quite dramatically. We fixed it. How did we fix it? The government went into the big deficits. The Federal Reserve, as this chart that I just showed you, printed up gobs of money for the banks. They bought up a lot of the toxic waste, which has not been marked to market, but that's a small item. And they bailed out the system of having too much debt and debtors who couldn't pay it off by increasing the debt, particularly government debt increased dramatically. And that isn't a fix that's stable. So the crash that we are about to have happen is based on the same problem, namely too much debt. In this case, government debt, local government debt, central government debt, and a significant return of consumers who never really unwound their debt, as they can manage very high amounts of debt at low interest rates. But the problem here is, if a loss of confidence happens in the currency itself and people want to be compensated at a reasonable level, or if the Fed feels the need not to suppress financial repression, retirees' ability to get a small amount of money return on their savings in a savings bank by letting rates return to a supposedly normal level, then the amounts to be paid by debtors cannot be managed, and the whole system crashes in a self-fulfilling feedback that looks to me just as bad, if not worse, than the previous one, requiring even bigger bailouts that add to the lack of confidence in a spiraling vicious cycle. So I think that we could be headed to something at least as bad as it was before, because we never really fixed those problems. So I'm suggesting that we be very cautious about holding things like annuities or bonds or things that would be denominated in a fixed number of dollars, and look for better investments that wouldn't be destroyed by the fact that dollars get printed up inevitably by the Fed to bail out the government and the banks yet again in another recession, and that you should be prepared for finding ways to save yourself from what I think is an inevitable destruction of the paper currencies of the world, not just the U.S.
And what you lay out, Bud, is a lot of how we think, and we've kind of broken this into two sequences. There's a downdraft first, and in our minds, the risk is a decline in asset values, probably centered in equities today. But shortly thereafter, there's a likely, if not certain, response by central banks around the world to pump the system again, and maybe with a death blow at some point, and devaluing currencies and risking inflation that we at least haven't seen in an outright fashion where most people notice it. So I guess as we think about those two phases, just give us some thoughts on investment themes in the short run here as we approach a recession and enter one, and perhaps investment themes as we're coming out of, or if not coming out of a recession, as central banks are actually reacting and printing money, assuming that follows.
Yeah, excellent question. Let me interrupt my answer with a little bit of commentary on inflation. The government numbers really don't add up. It's partly purposeful. They want to give everybody the impression things are okay. I live in California. I know how expensive it is here. I know the changes. It isn't anything like the 2% that's been suggested. And I can talk about hedonic replacement and substitution of hamburger for steak. And I can talk about taking the advantage of the technological improvement of computers as a price decline, when in fact we just buy more computer and spend the same amount, and add in a few more calculations that just aren't right to get to the CPI numbers. But the bigger missing component of defining what inflation is that asset prices, particularly, let's say, the stock market, are not included in the measure of inflation. With cheap imported goods, manufactured goods, which are measured, will look quite stable. But we already do have inflation. So I am not predicting big deflation. We had a little deflation around the crash in 2009. And I don't think it'll be too serious in the standard things we deal with and buy. I don't think the Chinese are going to lower their prices of manufactured goods to us. But I do see deflation in asset prices of particularly the stock market. So here's an opportunity for investment. Point one, in the short term, maybe look for over-leveraged companies that can't find the cash to keep going. Short them. Maybe some of the over-leveraged lenders to frackers. Short them. Maybe be more careful about investments in general. Just back out of things like general stock indices. And during that time, it's not so bad for bonds, because people take their money out of the stock market, put it into bonds, and rates stay low. But I think the longer picture, as you pointed out, when people actually do lose confidence and want to get out of the lowest interest rates we have ever had, 0 for the Fed funds rate, and below 1% at short while for the 10-year, I think there's a catastrophic kind of self-feeding in the other direction of lack of confidence in the hot potato of financial assets that are fixed income, and that should be prepared for. It's not imminent, I don't think. I'd say when we're in the middle of a recession, people usually aren't bidding up rates. But think of what the interest rates go to when you have hyperinflation. They go through the roof, as does a lot of other prices, which is because of the loss of confidence in the currency as opposed to loss of confidence in the economy. That's coming, but not as soon.
So it sounds like in the longer run, you're suggesting people have to be thinking about how to protect yourself in a world that's devaluing currencies and focusing on hard assets.
I'm a big supporter, exactly, hard assets, precious metals, real estate. I think oil is on sale right now. That's a little more complicated to invest in. I used to be a commodity trader. Rental properties, agricultural things. We're going to need to eat. There's an El Nino that's already in existence, a warming of the southern hemisphere's Pacific Ocean, and that changes weather. Hopefully good for the California of bringing some more rain here, but possibly the opposite in the Midwest. Perhaps grains take off next summer. It's on my radar list. I have not taken positions, but I am watching closely because I traded successfully grains in 1996 when they went up at times much more than anybody expected. I think those kinds of things are going to happen on a future basis, and the idea of buy and hold in a S&P index fund looks to me very dangerous by comparison.
Yes, absolutely. Well, let's go to our last topic, which we've touched on, which is a lot of the dialogue we have at WindRock, and a lot of what you brought up is this is not a normal economic cycle. It's a credit cycle. It comes to the root of money itself and the currencies around the world. And if we continue on a path of printing money out of thin air and debasing currencies, there's a real risk to investors and savers over time. Before we get to this chart, I mean, just as a backdrop, the US dollar has continued to play a role as, shall we call it, global safe haven in difficult times. And sometimes old habits die hard. So although we haven't been surprised by that, we also look forward to a future that you described, where when you add up honestly all of the present value of obligations on the US balance sheet, whether you're on the low range of 75 trillion or the high range of Kotlikov's number of 200 trillion, you're generally exceeding world GDP in what's owed today. So what lies ahead, Bud, for the world's monetary system and for the US dollar as you look out?
Well, in trying to predict the future, it's interesting to look at a historical trend. The next chart's one that you probably won't see anywhere else. It tracks how much of what kind of currency is used as reserves by all the central banks of the world, but in particularly the important ones around the world, to back up their issuing of their own currency. For years, the dollar was backed by gold, was supposedly as good as gold. Dollars were more available. Countries would put dollars in their bank and issue their own currency, saying it was backed by dollars. Also, world trade was pretty much defined as being done in dollars, particularly based on the petrodollar system. And there's quotes you'll hear that 60% of the reserves of the world are dollars. That's not quite so. It's 60% of the currencies we know when we know what currency there is, but there's a whole lot of backing of all the central banks' currency issue that's sort of undefined, called unallocated. So this chart combines the allocated and unallocated to whichever currencies they were. And in 1990, the dollar was 55% of all the reserves, backing all the issues of currencies in the world. That's a nice position because we print up that money, we give it to foreigners, they hold on to it, they don't spend it, and it increases our ability to spend our currencies as long as they keep those dollars. They then took those dollars and reinvested in treasuries, and that's why we have things like the treasury holdings of Japan and China of close to $1 trillion each, just to back up their own currencies. But it's dropped pretty dramatically. The euro grew, and we're down to like a third of the total right now. And if you just take that trend and project it out to 2020, it's going to be 25%. At that point, the U.S. economy is 25% of the world. We have no special position. And in fact, I believe the special privilege of being able to be a world debtor in the sense of buying all the world's goods without actually producing as much to sell, namely a trade deficit that foreigners financed by reinvesting those dollars in our own treasuries, and giving us a special privilege of having a huge debt and still a strong currency will go away. So I think the feedback loop through the international trade situation is about to collapse, and that crack where foreigners, in this case China, announcing $100 billion officially of selling off of treasuries, is a possible start of something that could be quite dangerous for the financial system. Surely our Treasury will call up Chinese Treasury and have discussions, but when we are not on the best of terms with our roiling up things like Sadako Islands and supporting Japan, who knows where this thing could go. And I see world dissatisfaction with the U.S. growing dramatically, and we're not in a position to defend it without potential serious problems. And this chart is an intent to indicate a weakness that I think our current batch of politicians don't even understand, and certainly are not trying to explain to the public.
Yeah, this is a very interesting chart. Thank you for that insight. And I guess with that, Bud, I'll leave it to you for any closing comments. And also, I'd like you to tell the listeners about the services at Casey Research and how they can learn more about your work.
Thanks. It's been a fun time to talk, Brett. Well, I'm chief economist at Casey Research, founded by Doug Casey, an old-time and long viewer of markets who correctly saw the importance of things like precious metals, and along the way has been worried about how long we can have a significant recovery. He and I were both predicting the drop in the stock market we've just seen. I typically contribute this sort of big picture view. Go to our website, caseyresearch.com, and you'll find a number of free resource letters you can sign up for, and also ones that might be specific to your particular interests in resources, precious metals, and my view of the big picture economy.
Great. Well, thank you again for your time today, Bud. It was very insightful.
Great talking to you, Brett. Good luck with all the things you're doing.